So, if you're investing, you're taking on risk. It's just part of the game. But what does that word risk actually mean? It's not just about losing money. It's about really understanding the forces that can throw your financial future off track. So in this explainer, we're going to break down risk management, not as some way to avoid all danger, but as a smart strategy to navigate right through it. Let me ask you this. What do you think is the single biggest threat to your investments? Is it one of those sudden, scary market crashes that just wipes out 20% of your portfolio overnight? Or is it something quieter, like the slow creep of inflation that just eats away at your savings year after year? Or, hey, maybe it's just that one company you really believed in that suddenly goes to zero. The answer you lean toward really says a lot about how you see the whole world of risk. All right, so before we can even think about protecting ourselves, we've got to know what we're actually up against. Let's start with the absolute foundation. What is investment risk really? And here's the surprising thing. It's not something you have to be afraid of. It's something to be understood and, at the end of the day, something you can control. So, what is risk management then? Well, it's not about avoiding losses entirely. It's an active three-part process. First, you have to identify the potential dangers out there. Then you need to understand how they could actually affect your goals. And finally, you take very deliberate steps to control them. You can think of it like playing both offense and defense with your money. Let's just demystify the word risk for a second. It sounds pretty terrifying, doesn't it? But in the world of investing, it really boils down to something kind of simple. It's the chance that the story you told yourself about an investment just doesn't come true. It's the gap between the return you hoped for and the one you actually get. That's it. Now, here is where a lot of investors get tripped up. They think risk is just another word for volatility, the daily ups and downs of the market. But that's only one tiny piece of a much, much larger puzzle. Let's dig into the real dangers that go way beyond just a bumpy ride. Okay, so this slide just breaks it down perfectly. On one side, you've got volatility. Think of this like turbulence on a flight. Yeah, it's uncomfortable, it's stressful, but the plane is still heading to its destination. This might be the whole tech sector having a bad month. But on the other side, you have fundamental risk. This is engine failure. This is when the company you invested in is, say, exposed as a fraud and its value is permanently gone. The key takeaway here? Just because an investment seems stable and isn't bouncing around doesn't mean it's safe from that catastrophic failure. Okay, so we know what risk is. But how much of it should you actually take on? Well, the answer isn't the same for everybody. Not even close. It's deeply, deeply personal. So this next part is all about figuring out your own unique risk appetite. Just look at how these different factors shape your personal risk profile. Your age and your time horizon are absolutely huge. I mean, a 25-year-old has decades to recover from a market downturn. Someone planning to retire in 5 years? They just don't have that luxury. But maybe the most important factor on this list is your own emotional wiring. Can you really stomach watching your portfolio drop 20% without panicking and selling everything at the absolute bottom? Answering that question honestly is so crucial for building a strategy you can actually stick with. So, once you understand yourself, you need the right tools for the job. We're going to shift gears now and get into the practical, actionable steps you can actually take to build a resilient portfolio that lines up with your personal risk appetite. And here it is. This is the single most powerful tool in your entire risk management toolkit, diversification. It's all built on a very simple but incredibly powerful idea. You don't know the future. And because you can't predict which investment is going to be the big winner, you just own a little bit of everything. That old saying, don't put all your eggs in one basket, it's not just a cliche. It is the absolute bedrock of sound investing. But what does diversification actually look like in practice? This slide shows you the three main layers. First, you spread out across different asset classes. Stocks and bonds, for instance, often move in opposite directions, which can help smooth out your returns. Second, you spread across different sectors. A crisis in the energy industry might not affect the healthcare industry at all, which insulates you. And finally, you diversify across different countries and regions, so your entire portfolio isn't held hostage by the economy of just one single country. Now, diversification is definitely your main line of defense, but there are other tools. A stop-loss order, for example, is basically a preset instruction to sell a stock if it falls to a certain price. It acts like a safety net to cap your losses. Asset allocation, that's your strategic blueprint, deciding you'll be, say, 60% in stocks and 40% in bonds. And portfolio rebalancing, That's the crucial maintenance. If your stocks have a great year and now they make up 70% of your portfolio, rebalancing just means selling some of those stocks and buying more bonds to get back to your original 60-40 plan. It forces you to buy low and sell high.
All right, so we've defined risk, we've figured out our personal tolerance for it, and we've looked at the tools to manage it. But what's the end game here? Why do we do all of this? Let's zoom out and look at the true goal of a good plan.
And this right here, this is the core philosophy. The goal of risk management isn't to be perfect, it's to be resilient. You will make mistakes. You will have investments that lose money. The real aim is to build a portfolio that's so well structured that no single bad decision, no single market storm can sink the entire ship. It's all about making sure your long-term goals can survive your short-term errors.
So, we'll leave you with this one final critical question. It's not about whether your portfolio is going to go up tomorrow. It's about whether it's structured with the discipline and the thoughtfulness to survive the inevitable storms and still get you where you want to go. So, is your portfolio truly built to last?